Welcome back. In studio is Conrad Wood, Head of Fixed Income at Momentum Asset Management, and Albert Botha, Portfolio Manager at Atlantic Asset Management, is down in our Cape Town studio, and of course my co-host David Shapiro from Sasfin in our Johannesburg studio. Albert, let's throw it down to you on inflation-linked bonds. It seems to be a big theme at the moment. Certainly John Oliphant of the Government Employees Pension Fund loves inflation-linked bonds, and so does Kimon Boyakis from Trident Asset Management. Your thoughts on inflation linkers?
Well, Bronwyn, I think it's a good time for government to issue them. Real yields are very low given historical levels. There's a massive demand for inflation linkers, both from local investors, from local pension funds, local insurance companies, and even from foreigners. So I think that as a government, it's a good time to be introducing new inflation linkers going forward. I also think that it's interesting that they introduced a 39-year inflation-linked bond. It does seem to indicate that they have a long-term dedication towards inflation targeting, that they want to stick with it, because they can't let inflation get out of control if they tend to want to fund using inflation linkers. The use of inflation linkers in portfolios, especially asset allocation portfolios, is a bit difficult to describe at the moment. There are some issues around inflation going forward. There are some upside risks. But on the other side, as I said, real yields are pretty low. So are you going to hedge yourself by buying inflation linkers, or do you want to rather go for some of the other products that might give you a higher total return if inflation doesn't surprise on the upside? I think it's a difficult question that you have to answer. Next couple of months we have some high inflation carry and survey months, so it might be a good call over the next month. But over the long term, I think it's going to be interesting to see what happens to inflation.
And we're going to put exactly the same question, the difficult question, to Conrad Wood.
Look, any time something gives you 13% in fixed income space in the year that's just gone past, one needs to just have a closer look and think carefully about prospects. Like we chatted a little bit on nominal bonds, I think you've got a lot of time on these. Yes, real yields are low at 2.3%, but real yields are a relative game around the world. The UK is at -2, so we have a 4.3% real rate gap with the UK. We have fairly high yields in real yields in emerging market context as well. So while I agree with Albert, 2.3 is low by historical standards, we're in a very low real yield environment for a long time here. Our view is that real yields in South Africa will go below 2%, and you have rising inflation and falling real yields. That's a perfect storm for inflation-linked bonds. And we think they'll come pretty close to doing double-digit returns again this year. The main risk to them is that, like Albert's raised, that government sees them...
Sorry, is that because inflation will surprise us on the upside?
You get your total return in these instruments from two components. Number one, you get whatever inflation does. So let's say inflation does 6.5, even 7 this year. Yeah. You get their yield, which is currently 2.3, but you also get capital gains when their yields decline. They're like normal bonds. In fact, they're more sensitive to yield declines than normal bonds. So we're looking for 1% or 2% of capital gain from them, in addition to their 2.3 yield, and we expect inflation to go close to 7, and that's how you get to close to double-digit returns from them. If the government sees them as a strong source of funding and hits them really hard, that would be the main risk to that view.
You mean issuing? Issuing a lot.
They bumped up issuance very, very surprisingly in Q3, Q4 last year without warning. Suddenly, the weekly auction was 200 million rand bigger, and the market choked on it initially. But once they realized that the 2.5, 2.6 real return at that stage was still very attractive, it came all the way back. And we watch issuance closely, because they're not the most liquid of instruments, but there's a lot of demand out there at the moment that should sustain.
Albert, let's throw this back to you, and I'm going to take it back to investment basics, bonds and cash versus other asset classes in the current uncertain environment.
Well, with cash it's very difficult, because we're sitting at 5.5%, and which is also historical low levels. So unless you are taking out a little bit more duration and a little bit more credit, it's very difficult to sit at 5.5% or 5.3% on call. So taking a little bit of risk there might be appropriate. On the bond space, there is some potential for downside, especially given the good budget we've seen. The budget was primarily positive and positive surprises. And then given the movements we've seen on the equity market locally, both from property and equity shares, there does seem to be a bit of a risk to the downside. However, as I said earlier, that the equity markets locally are extremely underbought by foreigners. Should, as David also said earlier, the interest rates overseas remain very low for very long, they will continue to seek risk assets. And at some stage, if the foreign buying or the foreign selling trend changes to a foreign buying trend, we might see equities and properties locally run quite a bit. I think there's an interesting proposal that might be the case indeed.
Conrad, your thoughts on this front?
Yeah, I think we've got time in bonds still. The gap between cash and bonds is just too big. It's very defensive. You can have bonds sell off still by 30, 40, 50 basis points and still come to that cash return. So we've got time, a year and a half, 2 years, where I think bonds are in the game, but we must just keep our eye on the fact that the interest rate cycle will turn at some stage, rates will go up. We expect inflation not to come down as much as what the budget sort of indicated and what the Reserve Bank indicate. That will put some upward pressure on bonds in time to come. We also think they're optimistic on their budget deficit projections, so that the supply
3%
scenario
in 2 years'
will
time.
deteriorate again. So on a 2-year view, we would be worried about bonds and the prospects for bonds. But you've got a bit of time now. It hurts not to be in bonds now because you're getting 8% yield and they're relatively stable.
I think that was a question I was going to ask. Are investors buying the numbers that the Minister of Finance released yesterday?
On paper, if everything happens that was sketched in the budget, we'll be fine. We'll be A for away. It's bond nirvana. Growth is stable to measured. Inflation's well behaved and it comes back and the budget deficit shrinks. But there must be some doubts around those numbers from our perspective, particularly on the budget deficit.
Albert, do you have doubts around the numbers tabled by the Minister of Finance in the budget yesterday? Specifically on that budget deficit, 3% of GDP in 2 years' time. We're sitting at government debt expected to be at some 33% of GDP also in 2 years.
I agree with Conrad. I think that there is some risk to the upside with the budget deficits, both now and the total budget deficit. We still sit on a primary budget deficit of targeting negative 0.3%, which is not ideal. Firstly. Secondly, revenue projections going forward is higher than real GDP growth, which is always dangerous to do. That means you're going to have to find alternative sources of income, whether that's new taxes, whether that's higher taxes, whether that's better tax collections. It's difficult to see where that comes from. So yes, there are some dangers going forward. However, I mean, we've seen that the government be relatively fiscally conservative with this budget and their forecasts. So we can hope for the best, I think, but definitely there are some risks going to the budget deficit numbers.
You've got 20 seconds to ask the question and get an answer.
How do you hedge against your fears in the fixed interest market? You know, if you fear in 2 years' time that this is going to happen, how do you put a hedge in place?
If it happens, it's going to be because of rising inflation. I like inflation linkers as a very good hedge going forward.
Albert, do you want to comment on that before we close the show?
Well, if you're afraid that the South African government are going to overshoot their budget numbers, South African fixed income can invest overseas. There are a couple of nice opportunities in other developed and developing markets, especially in the corporate space. Some of the foreign corporates are looking extremely cash flush and extremely safe. So that's always an option. Inflation
we're going to have to leave it there.
Also possibly
that's
an option.
Enough for us.
If inflation rises, cash is going to go with it.
Albert, thanks very much. Appreciate your time. Conrad Wood joining us is the head of fixed income at Momentum Asset Management, and of course Albert Botha from Atlantic Asset Management down in our Cape Town studio. A big thank you to you both, and of course to David Shapiro from Sasfin, my co-host.